Well, lots to talk about in terms of individual names as well. Ed Yardeni is President, Yardeni Research. He's with us now to take some questions. Ed, good morning. Great to have you with us here. As we were joking, Goldilocks is back in the house, after a 1 week scare. What do you make of it, Ed? Do we sort of simply just sort of go back to the market we were in, which is this, the mega cap, the sort of AI-led Nvidia, for example? I was just looking. Has added some $700 billion, added back $700 billion in market cap since the August 5th lows. The S&P itself has added some $4 trillion. So we're back there once again?
Yeah, happy days are here again. And I think rightly so. I think when we talked about the payroll employment number that came out for July at the beginning of the month, I was skeptical that the labor market was that weak. I really thought a lot of it was weather related. And I was looking for initial unemployment claims to come down, which they did on Thursday morning here in the United States. And that certainly helped to revive sentiment, as did the retail sales numbers. And we've also been thinking that inflation will be moderating. So we've been talking about what we call immaculate disinflation, the idea that inflation can come down without a recession. And so far, so good.
Right. No, absolutely. And you think we will get that, right? I mean, some have said in the real world it doesn't happen. Sometimes it does.
Sometimes it does. And I think it's happening because I think the Fed last year averted a credit crunch, which is what in the past has caused recessions. I think we have to really focus on what I call the credit crisis cycle. That is something that economists have generally ignored. The fact of the matter is that in the past, when the Fed raised interest rates, something broke that led to a credit crunch and a recession. This time around, what's different is the Fed was very effective last year in providing a liquidity facility to avoid a bank run. We had some bank crisis back in March, and the economy is underlying it all resilient, and it's, I think, less interest rate sensitive than it's been in the past.
Ed, good morning. Great to have you on. So now that we're starting to see a string of positive data, very different from the big scare that we had about a fortnight back, would the Fed be expected to keep cutting gently, gradual cuts? And then, are we back to assuming that we get a soft landing and everybody's happy again and then equity markets start rallying again? Is that the way you see it right now? Of course, maybe it changes with the next jobs report, we don't know, but what's the prognosis right now?
Well, I think the next jobs report is going to be on the strong side because I think, as I said, a lot of the weakness in July was weather related. So we should see some reversal in August. I think the other development here is we had that carry trade unwind scare. And I think that was the main reason that things really came unglued. And that seems to have stabilized, partly because the Bank of Japan has said that they're not going to tighten as aggressively as they threatened to. But here, with regards to the Fed, I think all this talk about an emergency rate cut, I think that was nonsense. And I think what we're going to get is 25 basis points because that's what Fed officials have promised many times. I don't think we're going to get 50 basis points. And as I said last time, I think it's going to be one and done, I think, for the year. I think they'll cut in September, and I don't think it will be a cut in November and December.
Interesting. Hi, Ed. Good morning and good to see you in. What about the yen carry trade? Has that played out? I mean, various estimates from 50, 60, 70% to not sure what's going on there. What is your estimate? Has that yen carry trade played out mostly?
It seems as though it has played out. The problem was that when the yen started to strengthen and the BOJ talking about raising interest rates, that created a real problem for all these speculators and traders that had borrowed in Japanese yen at zero interest rates and put the money in the Magnificent Seven. Maybe they put it in Mexico, Brazil. So all these things unwound very, very quickly, and it created a panic. And the Bank of Japan came in and stabilized things by saying that they weren't going to rush to raise interest rates. So that did calm things down.
All right, Ed, we'll leave it there. Great speaking with you, and good conversation and good perspective. So we're back to where we were in a good way. A one rate cut, no panicky rate reactions, and the market seems to be looking good. So I think that conversation, and of course the global backdrop, provides a little bit of confidence for the market here as well, because things got a little worse here. Especially in the small cap space, you may not realize it, but especially mid and small caps in many cases are down 15, 20, 25%, even though the indices will only show you about 5% odd cut from the top. We'll take a